I'm Charlotte McLeod with the Investing News Network, and here today with me is Randy Smallwood, President and CEO of Wheaton Precious Metals. Thank you so much for joining me today. Great to see you.
Charlotte, it is always a pleasure. Thank you.
Yes, good to be talking with you today. And I think where we're going to start off is with the gold price. The last time we had a chance to speak, I think it was back in March or April of this year, and you were saying the reasons to own gold were really stacking up. And I think that a lot of expert market watchers would really agree with you, but I know investors are getting quite fatigued with what the price is doing. So to begin, could you talk a little bit about what you see the headwinds for gold as being at the moment?
Well, right now it's a strong U.S. dollar. On a relative basis, the U.S. dollar, we've seen a pretty heavy shift towards the U.S. dollar and away from other currencies around the world. And so anytime, as long as we measure gold in U.S. dollars, whenever you see that kind of a shift, it's going to provide a bit of weakness. What I've been pleased with is that with that shift towards the U.S. dollar around the world as a fiat currency, gold has actually withstood it relatively well. We've seen gold drop down into the 1700s, but it's already building its way back up again. And I really do think that we've established a new floor, a new basement for gold, and it wouldn't surprise me at all especially when you look at the fundamentals behind that strong U.S. dollar. I think we're setting ourselves up for a breakout sometime in the next couple of years for gold, where we can set some new record levels in terms of pricing, because the reasons for owning gold have never been stronger.
Yeah, and I think it is so important to remind people about that base level that seems to be coming, the fact that it remains historically high. I do wonder, though, when you're doing forecasting as a company, when prices for gold and other metals don't do what we necessarily think they should do, does that make it tricky for you?
It does. To be honest, we've had better success in terms of the price being higher than what we forecast. And so that's always a pleasant surprise, but there's no doubt there's risk the other way. And so we do try and temper it. I myself am very bullish about gold prices, but when it comes to investing our shareholders' capital, I don't use those beliefs to justify purchases and purchase prices. We use a conservative price that is based off of the spot price of the day. It's a function of that, of the spot price of the day. And so even though I believe gold will be up over $2,000 in the near term per ounce, we're not going to invest based on that belief. We're investing based on the spot price of today and where that stands. And so that's a real key, differentiator, is that just making sure that you stay conservative with respect to what we're investing into.
Yeah, that makes definitely a lot of sense. I want to touch on inflation as well. This is something that we've spoken about before, but of course it remains a key issue in the world today, especially in the mining space. One of the benefits we know of royalty and streaming companies is that they're sheltered from issues like that, but you work with a lot of different companies, and I wonder what you're hearing from these mining companies that are feeling the effects of inflation today.
Oh, it's a real issue. We are seeing it with our partner operators, the ones that are running the mines and operating the mines. They are seeing inflationary pressures that to be honest, are higher than what we're seeing reported for the general, from different governments around the world. And so we're seeing, contingencies and being chewed up as these mines are being built and working forward. It is one of the huge advantages. So for us as a company, we are protected from that. Our costs are defined by the contract, fixed by the contract. And I've always said, as an inflationary hedge, I don't think there's anything better than a streaming company, because we have leverage with the production payment on a per ounce basis, but we don't have cost risk. Our costs are defined on both the capital side and the operating cost side. And so to be honest, our cost per ounce actually dropped year over year from where it was a year ago. And it's a good, stable, forecastable cost that doesn't bring that risk in. But for the operators out there, all you have to do is look around at the cost of fuel, the cost of steel, the cost of copper, the cost of, like, all the way across. You just see higher base commodity prices, and these are the core components for everything that we consume in this world. And there's no doubt it's going to continue to have an impact. It's funny how optimistic everyone, we've had a little bit of a flatter trajectory here just recently in the last couple of days, and everyone's jumping on the bandwagon and saying we've seen the worst. One data point does not indicate a trend. I'd like to see some more strength behind that, because we're not seeing it in the mining industry.
Wow, yeah, that's definitely so true. And okay, so as we've talked about, you're sheltered from issues like inflation, but as you've also been mentioning, you do have all these relationships with the companies. Are there times when they come to you and say, we need some extra help with something? How do you respond to things like that?
Well, I've always highlighted that streaming agreements are one of the biggest advantages of streaming agreements is that it's a partnership, and that we do work with our partners. And so we're always willing to provide technical expertise. We're willing to provide support. We co-fund social license support programs in terms of investing into communities to make sure that we leave some sustainable benefits with the communities around the mine sites. We're leaders in that field, and in fact have dragged the rest of the streaming and royalty space into the field with us in terms of providing that support. We're always open to discussion with respect to, and if there's ways that we can improve the contract, that it delivers better value. We do have an overlaying mantra in our company, and that is the stronger our partners are, the stronger we are. So we are always looking for ways to help our partners be more successful. And sometimes that means adjusting contracts to provide incentives in certain directions and such. Usually, and in fact, every time we've done it, it's been a win-win situation, and it just works well for us. And so the door is always open. These are partnerships. That's truly what a partnership is. And so we're always willing to find a way to help one way or the other. Ideally, it delivers benefits to both parties.
Right. And so today, what we're really here to talk about, we're here to talk about many things, but we had the company's Q2 results that just came out yesterday, I believe. So I have a couple of questions on those, but I wanted to first put it over to you if you could pull out the highlights that you would want investors to notice.
Well, our cash flows and earnings were all on track in terms of what we expected, but production is lower. And really, it doesn't take much to look through it and realize that our biggest asset, which is Salobo down in Brazil, has underperformed and continues to underperform. It's been about 3 or 4 quarters now that it's just not delivering to the levels that asset can. And we know it can, because we've been invested in this asset since 2015, and it has continuously outperformed up until the last couple of years, last year and a half, really. And so Vale continues to strive towards getting it fixed, getting it up and running to what it's capable of, and moving it forward. We did finally get down on site, and I will assure you and everyone out there that it's a lot better to get on site for a site visit than virtual. Virtual just doesn't cut it in terms of getting a feel for it. And so our technical team was down there in early June and saw significant progress, specifically in the mining area. Definitely have made some major improvements in terms of equipment reliability and such, but there's still work to be done, and most of it's in the processing area, and Vale is committed to that. They've brought in some stronger management to try and make this move forward. So that's, really, I think what that's forced us to do is reduce our guidance for 2022, just because the significance, the drop that we've seen at Salobo is so significant. We don't think we'll be able to make it up, even though we've got other assets that are outperforming this year. It's not going to be enough to offset the negative on Vale or on Salobo. And so we wanted to make sure that our shareholders had clear guidance on that. So we did update our guidance both for 2022. We also updated our long-term guidance, and that's not really a Salobo issue. That's more Stillwater and Rosemont and selling off Keno Hill and some other changes, Toro Peru and Voisey's Bay. Those are all longer term changes that we've seen that are having an impact on the longer term. So that's not related to Salobo so much. That's related to other assets in our portfolio where we've seen changes in production plans or delays in terms of moving forward on expansion plans. And so capturing that and giving an update. And one never likes to reduce guidance, and it's the first time we've ever had to reduce guidance in our company. I think all the way back to probably 2013 was the last time. But sometimes you just can't capture all those contingencies and all those risks when you're originally looking at it. What I can assure you is Vale is doing the best they can to bring Salobo up to speed, and we expect it to get back to its glory days like it's been for so many years for us.
Well, and it's great to hear that you've been down on the site to take a look around. People do always say it's so much better to see it in person, so I'm sure that helped with your confidence as well. On the note of production, I wondered if you could talk a little bit more about what's going on with Keno Hill. That was an interesting situation to me. And then over at Stillwater, I believe were there weather kind of issues that were a bit unique during the quarter.
Yeah, the storms in June down in the Montana area, and of course we all saw, I think everyone saw the pictures out of Yellowstone, which is just south of the Stillwater operations, and devastation. Highways entirely washed away and disappeared. Well, the Stillwater mining complex is made up of two mines, the Stillwater mine and the East Boulder mine. And the East Boulder mine continued operating. It didn't have any problems, there was no road washouts, but the Stillwater mine, the access road disappeared. And so they had no way of getting into the site itself. They had to move people around by helicopter to get in and out, and they had to rebuild an entire access road. There was also some damages, to some of the tailings lines that were exposed, washed out. Nothing was broken, and they didn't lose anything, but nevertheless, they have to rebuild that infrastructure and get it going. And so that, combined with some challenges they were having on Blitz anyways, has resulted in the scaling down of our expectations at Stillwater. Still a very good mine. We haven't lost the ounces. They're just being deferred. They're going to come out in a later time. And I would say that's the issue with all of these. We haven't lost any ounces here. This is all about timing in terms of when these ounces get produced. On the Keno Hill side, it's an asset we invested into way back in 2008. We paid $50 million for the stream back then. To sell it for $135 million after collecting $50 million in silver from the mine, it's delivered a fantastic return for us in terms of, and that was really it. I'm a strong believer in the asset. I think it's got very high quality, very high grade. I think the district itself has good tenor and good exploration potential. But when we looked at the proposals, we spent a lot of time talking with Hecla about moving this forward, and we had some options to continue streaming at the site. But when they came back with the offer for $135 million, it didn't take us much. We sat and looked at our expectations in terms of how Keno Hill was going to move forward. Hecla's got a lot of work to do there to try and catch up to, all the challenges and clean up all the challenges that Alexco has left them. We just didn't see an opportunity for us to get $135 million out of this asset in a near term, and we just see better opportunities to put that money in. So we decided to take the opportunity. We, as a management team, we are paid not only to just make acquisitions. We are also paid to manage our portfolio, and this was just a better value than what we carried the Keno Hill stream at in our own books. And it was a deal we couldn't say no to. So it's a good deal.
Okay, well, thank you for explaining that. I think that all provides really good context for investors. I want to talk a little bit about revenue as well. I think it was down a little bit, partially due to fewer ounces being sold and, of course, lower pricing, right? So I wondered if, in circumstances like this, would you ever consider holding back selling in the market?
No, it's in our eyes, our investors are precious metals investors. Obviously, they wouldn't be holding our stock, and that is who we work for. And so I really do try and understand what their incentives are, what they want. And in my eyes, investors buy into Wheaton Precious Metals to get exposure to profitable precious metals production. And when it comes to holding silver and holding gold, holding precious metals, our investors have the opportunity to do that on their own if they so choose. But as soon as I start doing that, I'm forcing every single one of those investors to have exposure to physical gold. And to be honest, I'm not physical gold, I appreciate people holding physical gold, but I think the best way to invest into precious metals is not holding gold, but is to buy Wheaton stock. And so our focus is not to hold it. Our focus is to sell it into the market and not get into that situation. I will say it, especially in the silver market, not so much the gold market, but if we held back much of the silver market, it would have an impact if we decided to turn around and sell that into the market. So the concept of holding gold is sort of founded on the belief that eventually you're going to sell it at a higher price. But when you sell it at that higher price, all you're doing is putting negative pressure back onto that silver market. And so I really don't quite understand some of the logic. Obviously, you hope you can sell it at a higher price than what you bought it at, as you do with any commodity that you're investing into. But I'm not going to take that decision out of our shareholders' hands. I let them decide if they want to do that. And there's lots of avenues for them to invest into physical gold and silver if they so choose.
Well, okay, and that's very interesting. I love to hear that you're really in tune with the shareholders. How are they feeling after this latest results release? Because I know they did also, you've announced a dividend as well, so that's in the mix.
Yeah. Yeah, no, I mean, as I said earlier, I don't like reducing production guidance. We never have before. We are a very conservative company when it comes to our production guidance. I've said, traditionally we are about 10 to 15% less than our partners' production forecasts on an overall basis. And so, it's not something that we take lightly. I never want to do it again. I've always said one of the strongest differentiators in Wheaton is we don't point fingers. This is our mistake. This was our fault in terms of not coming out with appropriate guidance at the start of the year. Obviously, we don't operate these assets, but our shareholders pay us to know what's going on. And it's clear that we made a mistake here in terms of our forecast, but we've clarified that. We've provided that updated guidance. We're confident in terms of the numbers that we're coming out with now. And trust me, I'm striving to make sure that this never happens again.
Of course, of course. One topic that I also want to talk about is ESG, because a couple of months ago, you released the company's sustainability report, and you've been talking about how you've kind of really dragged the rest of the royalty and streaming space into, performing better on that note. ESG, I think we all know at this point, it's really important in the mining industry, but one of the difficulties is knowing how to measure it and understanding when a company is doing a good job. I think, of course, you've thought a lot about this. So how are you meeting that challenge?
Well, it is a challenge because there's at last count, we had 15 different rating agencies on our watch list in terms of who's out there. And I hate to say it, when one company gets rated highly by a rating agency and then gets rated low by a next rating agency, I mean, if the ratings aren't replicable, what do they actually mean? Are they worth anything, right? And that's the challenge. And so it's education that's required. It's spending time to go through and have a look at it. And it does concern me that rating agencies will sometimes not go through the effort of trying to learn more about the company before they come out with an opinion on the company. We do need to get more consistent on that front. If we don't get more consistent, people will stop listening. It has to be a replicable number. It has to be something that can be repeated and recalculated and come back, and it should be relatively consistent in terms of company's performance. We're fortunate. We continually rate as the highest of the precious metals companies by a few of the different rating agencies, the ones that are more widely accepted. We do put a lot of effort into it. It's something that's really important. And, in the last quarter, committing to, first off, taking a revolver so that it's got a sustainability performance component attached to it, so that if we don't perform, it costs us more. And if we do overperform or deliver improvements, that will receive some benefits. That's a big change for us. So our entire debt facility is now tied to sustainability initiative. We also committed, of course, to net zero earlier on this year, which is, something that's important to us. And that does include scope 3, which means we've got some work to do to help our partners get better. And that's an important thing. And we've got a fund now putting together that we're looking to try and help our partners make better decisions with respect to how they source their power, which is usually the biggest issue in the mining industry. Is where does the energy come from that drives the mines, given that most mines are in remote locations? Diesel powered generators are very, very costly. Coal fired generators, we don't have any coal fired generators in our portfolio, but some of our peers do. Those are very, very expensive from an ESG perspective. And so we just need to help our partners make better decisions. And we've now got a fund set aside that is designed to explore those opportunities.
Well, that's certainly great to hear. As we're looking more toward the future, I think one thing that I am definitely hearing about is how difficult it is for mining companies, especially on the smaller end of the scale, to get financed right now. So I imagine that creates opportunities for you. What are you looking for in an environment like this where there are many companies who probably want to work with you?
Well, again, it comes down to the qualities of the assets themselves. It's the operating margins that we use as the main criteria. Political risk is becoming more and more of an issue. We've seen some surprises out of Chile and maybe not as much of a surprise, but some changes in Colombia that make it very tough to make long-term investments. It's just getting more and more challenging to find jurisdictions where you're confident that you'll be able to generate a reasonable return on your invested capital up front. And so jurisdiction does come into play. That being said, for us, the most important aspect is the operating margins of the asset post the stream, making sure that our operating partners are very profitable. And again, going back to the mantra earlier on, we have a mantra here: the stronger our partners are, the stronger we are. And so we need to make sure that there's healthy margins that deliver benefits to all the stakeholders. And that includes the governments that will be receiving taxes from there. It includes the communities that were receiving the employment and the associated benefits from bringing in high paying, high standard jobs into rural locations. The communities, making sure that there's good, strong benefits coming back to the communities in terms of infrastructure support, power supply, health supply, education, all very important factors that really help elevate the standard of living in rural locations. And mining has got an incredible opportunity to deliver this to society, while we also deliver the minerals that we all need in terms of not only existing, but improving our society, our planet. And so, it's just, these are all factors that come into play. You got to make sure that there's healthy enough margins to make sure that the asset can carry that. And that includes, potential increases in taxation, potential increases, inflationary increases, and still be a good profitable mine. That's the most important criteria.
All right. Well, as we are wrapping up, we've made it actually more than halfway through the year. You've done some readjustments. What is the rest of 2022 looking like for Wheaton Precious Metals?
Well, we're looking forward to having Salobo 3 get some material through. They expect to still move the first material through the Salobo 3 line by the end of this year. They're already doing some commissioning on the primary crusher and some of the grinding areas and stuff like that. And it is at 95% mechanical completion. Unfortunately, that last 5% is a lot of wires and pipes and very, very labor intensive in terms of connecting everything together and then doing the data programming and the automated systems that so many of the mills run on now. It is a standalone line separate from line 1 and 2. So all of that happens and it doesn't have any impact on the existing operations. And so we're looking forward to seeing some of the first material move through Salobo 3. We are very busy on the corporate development front, and we've got a very strong balance sheet, pretty close to $500,000 at quarter, or $500 million at quarter end. And I can assure you it's climbed even higher than that currently. And so, we are busy on that front in terms of finding ways to put that money in the ground, and we're hopeful to maybe add at least 1 or 2 more deals before the end of this year. In terms of funding growth, the opportunity set we're looking at is generally development at single asset companies, development companies. And so it doesn't mean immediate production, but it means a very, very strong growth profile. And it's one of the reasons we, really reinforced with our updated guidance. We still have an incredibly strong long-term growth profile in this company.
Okay, well, that is great to hear. Thank you for taking the time today to go through what's going on at the company, the Q2 results. Really appreciate it.
Always a pleasure. Thank you, Charlotte.
Great. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Randy Smallwood with Wheaton Precious Metals.